Welcome to the Explainer. Look, if you trade highly volatile indices like Nifty and Bank Nifty, you know this pain. You do all your analysis, you execute the trade perfectly, and then bam, you get stopped out. It honestly feels personal sometimes, right? Well, today, we're diving deep into some seriously fascinating source material to decode exactly why this happens. We're going to unpack institutional market psychology and the liquidity sweep theory. And let me tell you, this isn't just some textbook theory. This is the hidden machinery that actually runs the market.
So, seriously, have you ever asked yourself why the market seems to laser target your stop loss right before reversing and going exactly where you predicted? You had the trend dead right, but you still lost money. It is so maddening. But according to our breakdown, it is not just bad luck. It's actually a highly efficient, deliberate process executed by large institutions.
And that brings us straight to this absolute foundational secret. Market often goes where stops are, before going where the trend is. Think of this as the golden principle. If you really want to understand the unseen forces moving the market every day, you've got to internalize this quote. The market doesn't just wander around randomly. It actively seeks out areas of high friction and high volume. Basically, it hunts the stops.
Now, think about the perfect contrast between two totally different mindsets here. On one side, we have the predictable retail mindset. We are all taught the exact same basics, right? If resistance breaks, buy. If support breaks, sell. It's textbook stuff. But then there's the institutional or smart money mindset. They aren't looking at the breakout at all. They're actually looking at you. They're sitting there asking, where are the retail stop losses? Their whole objective is to take that liquidity first, before pushing the market in its actual intended direction.
Let's just demystify this jargon right off the bat. When we talk about liquidity, all we really mean is available orders in the market. That's the whole secret. Large institutions, the big operators, the smart money, they are dealing in massive, massive volumes. They literally can't just click buy or sell without moving the whole market against themselves, so they absolutely need these giant pools of available orders just to enter or exit their positions efficiently. And where do those pools sit? Well, they sit as buy-side liquidity, like stop losses and breakout orders right above previous highs, and sell-side liquidity, which are stop losses and breakdown orders sitting just below previous lows.
When we visualize how this plays out, it's like a giant trap. Picture a buy-side liquidity sweep. Price creates equal highs, that classic, obvious resistance zone. Retail traders see this and instantly think, oh, a breakout. Price pushes just above those highs, triggering all the retail buy orders and knocking out the short sellers' stop losses. And then it sharply reverses down. The retail traders are totally trapped, and the big guys have taken the liquidity. It's the exact same trap inverted for a sell-side sweep below equal lows. These trap zones are basically magnets that the market naturally gravitates towards.
Section 2. Indian Market Traps and How Nifty and Bank Nifty Hunt Your Stops. Let's get into the specifics. Let's pull this out of the theory and look at a real-world scenario. Imagine Bank Nifty has formed equal highs right near the 52,000 round number over a few sessions. That is a massive psychological level, right? Then, the event happens. A breakout pushes the price up to 52,150. What is the immediate action? Resale traders get incredibly hyped up. They buy calls aggressively, short sellers get stopped out, and boom, this creates a massive pool of buy orders. And what do you think the institutions do with all those juicy buy orders? They sell heavily right into them. Price then sharply dumps back down to 51,700. The breakout buyers are completely trapped, their premiums decay into nothing, and smart money walks away with the profit. Your excitement at the top literally became their liquidity. Now, flip that around, and let's look at the inverse scenario on Nifty. Say Nifty is holding strong at a support level of 24,800 for a couple of days. Retail is watching this like a hawk, thinking, man, if this breaks, the market is totally crashing. Then the breakdown actually happens. Price dips below support to 24,780. The retail reaction? Pure, absolute panic. People dump their holdings, they buy puts, and long stop losses get triggered everywhere. But listen, this flood of sell orders is exactly what the institutions have been waiting for. They buy heavily into that retail panic, and suddenly the price sharply reverses upward. The breakdown sellers are trapped just like that. So the really crucial point here is understanding when these traps are most dangerous. Expiry days magnify these traps like crazy. Take a Thursday Bank Nifty expiry, for example. Price is hovering near 50,000, and there is heavy call option open interest piled up there. Retail thinks, no way 50,000 breaks today, but suddenly the market spikes to 50,120. Those massive call writers panic and start covering, while retail buyers blindly chase the breakout. It's an absolute frenzy of buying, which, you guessed it, provides the absolute perfect liquidity for smart money to collect those orders and aggressively reverse the price all the way down to $49,750. It is a classic textbook options liquidity sweep.
Moving on to psychological traps, the anatomy of fear and greed.
To really grasp these sweeps, we have to look at the emotional exploitation behind them. Because at the end of the day, institutions need volume, and they rely entirely on your emotional reactions to get it. On the sell side, we have the fear trap. A break of support leads to widespread panic selling. Stop losses get hammered, and bam, the market reverses up. On the buy side, it's the greed trap. A break of resistance triggers intense FOMO, fear of missing out. Everyone piles in, stops are hit, and the market reverses down. Retail traders predictably supply the volume that operators require simply by acting on basic human emotions. Emotion creates liquidity, and liquidity creates opportunity for the big players.
Next up, the liquidity sweep strategy. Let's talk about how to actually trade alongside smart money.
Okay, so how can we actually build a tactical edge based on all this data? The biggest visual cue you are looking for on your chart is a long rejection wick. For a bearish sweep, you want to see price break above resistance, pierce right through the zone, but completely fail to stay there, creating a long upper wick and closing back below resistance. For a bullish sweep, it's the exact opposite. Price breaks support, leaves a long lower wick, but recovers and closes above the line. But here is absolutely the most crucial takeaway from the whole analysis. A liquidity sweep alone is not enough. You can't just jump in. The very next candle must support the reversal to confirm the move. Mandatory.
So what does the exact step-by-step entry strategy look like? Let's break it down. Step 1, identify those trap zones. We're talking equal highs, equal lows, or major support and resistance levels. Step 2, have some patience. Just wait for the obvious breakout or breakdown to happen. Step 3, look incredibly closely for that rejection wick, indicating liquidity has just been taken. Step 4, and honestly this is where most people mess up, you wait for the confirmation candle. If it was a buy-side sweep at resistance, wait for a bearish confirmation candle. Finally, step 5, enter your trade and safely place your stop loss right beyond the extreme of that rejection wick.
Now, let's rapidly fire off the most common retail mistakes that you absolutely have to avoid. Number 1, entering a breakout instantly. Remember, the obvious breakout is almost always the obvious trap. Number 2, ignoring volume spikes. A volume spike paired with a sweep is a screaming strong setup. Number 3, like we literally just talked about, entering with zero confirmation candle. Don't do it. And number 4, ignoring higher timeframes. The absolute ideal setup uses the 15-minute timeframe to identify these strong liquidity zones, and then zooming into the 5-minute timeframe for your precision execution. To wrap up our explainer today, I want to leave you with this final, genuinely empowering principle. Follow structure, not emotion. Follow liquidity, not the crowd. The market isn't out to get you personally, and it isn't random. It is simply ruthlessly efficient at seeking out where the most pain can be inflicted. Now that you've got this strategic lens, you have a real choice to make the next time you open up a nifty chart. When that super obvious breakout happens, are you going to be the liquidity? Or are you going to patiently wait, spot the sweep, and trade alongside the smart money? Think about it. Thanks for joining me on this explainer.